of $1 of revenue to your company. This is the thought that really struck me over the last week. And I was at a conference last week, and the big takeaway that I had from that conference was the Driven Mastermind. If anybody wants to join, it's a great mastermind group for uh, larger, small, medium businesses. And the big takeaway that I had was I need to be thinking bigger. And there were a lot of different touch points for that message to me in this last meeting that we had. But I got to thinking about the actual journey of $1 through one of our clients, world. Most of our clients are small business owners of one stripe or another. We do a lot of HVAC, a lot of real estate, but we have you know lots of other businesses as well. And I realize it's important to actually understand the flow of funds from $1 of revenue from a client or a customer to its end purpose. And what is that purpose? Because I've talked a lot in the past about how the difference between a small business and a big business is actually that the small business, its primary reason for existence is to support the owner. That is different than big businesses. And this is where private equity firms buying up HVAC or plumbers or whatever comes into play, because their whole, playbook is they come in, they no longer have to support the owner. They take all that margin that was supporting the owner and they reinvest that into growth and marketing. And ideally, that grows a larger business, larger enterprise value, and then they can sell it for more. Sometimes it works, sometimes it doesn't. But that's the general approach. And so it's that transition from small to big that allows private equity to do what they do. But for me and for Tax Sherpa clients, that's not really the story that we're working with. We are still in the small business world in that the business has to support the owner. And so I was thinking about all that, and I realized that by focusing so exclusively on the tax side of things, that we have been, or not delivering enough value that we could be delivering to clients. And so I talked to the team yesterday about this, and we are expanding what the route that we provide to clients is. So historically, we have a four-part tax planning framework: survey, route, trek, and compass check. So the survey is understanding the lay of the land, understanding where you are in your financial world, along with all the tax implications. What investments do you have, and what's your filing status, and do you have kids? Are you married? All that kind of stuff. And then we sculpt different tax strategies that fit the survey, and that is the route, or that was the route. And then the trek is actually doing the work, implementing all the plans, doing all the follow-up, and the compass checks are the updates along the way, typically quarterly, for those people who want that feedback on how things are going and any updates that you're going through. And so those are still in place, but we're just going to be covering more in the survey and the route. We're still going to have the route is still going to use the tax strategies to map out the track, but we're also going to include the business financial evaluation and then the purpose. And so what I did is I ended up creating what I'm calling tentatively the wealth climb. And it's the journey of $1 of revenue turning into wealth for the owner. And that's what I'm going to go over today here. So let me go and share this this little presentation I had my AI put together. I don't know if you can hear my kid screaming upstairs. It's always working from home sometimes. We got Basecamp, Ascent, and Summit. This is the Tax Sherpa map from business revenue to owner optionality. Talk about what that means here in a second. So, most business owners and most people who come to us say, how do I lower my taxes? But, that's an important question, but oftentimes it's too early. So the first question is whether the business is producing enough owner profit for the risk, work, size, and complexity involved. And most people skip over this entirely because, it's actually a lot harder. Um, you know, is your business throwing off enough profit for what it's doing? And for some people, the answer is yes, and other people, the answer is no. And there are guidelines for what that number should be, depending on your type of business, what you sell, how you sell it, and your, revenue size, basically. So the kind of three elements. There's Basecamp. This is your operating business. This is the preparation of a dollar turning into profit, owner profit, because that's what's available to you to climb the mountain up to establishing wealth at the summit. That climb is the ascent. That's converting that owner profit into usable money, and doing that in the most efficient way possible. And then at the summit, we have, this is your wealth layer. This is building the assets that make the business optional over time. And, optionality is really, really a key concept here because one way or another, none of us are working forever. So we need to develop the optionality of not working. And that could take in the form of retirement, that could take in the form of passive ownership, that could be taken in the form of any number of things. But the key there is to make the daily work optional because, like I said, none of us are working forever. I know that better than most. I went through 2 years of being unable to work, from COVID. So it's definitely a critical, critical resource to develop is that optionality, which is really, what people call financial freedom. When your wealth generates enough income to fund your lifestyle, that's sort of the classic definition of financial freedom. And so, you know, what we want to look at is the whole journey from dollar revenue through business operations into owner profit and then protecting that profit and developing that owner wealth. So let's dive into this a little bit. So Basecamp, the way I imagine this is, so let's say you're going to Mount Everest and you want to climb it. There are not just one, but there's actually several base camps on Mount Everest. And, this is where you get acclimated. This is where you prepare for the ascent. And so customer revenue comes in and it goes through your operating model. It's going to go through fulfillment. It's going to go through cost of goods. It's going to go through customer acquisition costs. It's going to go through OpEx systems and OpEx people. And like I said, depending on the type of business and what it is you do and all those kinds of things, there's different guidelines as to what parameters those should be compared to the revenue. One of the big mistakes that small business owners make is they try to take themselves out of the business too early. And if your revenue is $200,000, it's very, very difficult to justify hiring people to take over your job because there's just not enough margin in there to do that. So there's kind of someday I'll finish my book on this. It's what I call the lifestyle efficiency ratio, and at $200,000 to $300,000, there's kind of a plateau of lifestyle efficiency from the business. And after 300 up to $1 million is, a trough in lifestyle efficiency. So even though a lot of people end up with more revenue, they don't end up with more profit because they're growing the team and that's expensive. And then once you get past $1 million, usually it ramps back up and exceeds the plateau at $200,000 to $300,000. So, all these kinds of things are what I call the ClearPath insight framework. And it's a detailed, breakdown of how money should flow through the business. And that's what we use, like with all of our bookkeeping clients. We have started organizing the books in a way that lets us easily see the ClearPath ratios and, develop some tooling to do all that kind of stuff. But, I haven't made much of a focus on it because, like I said, the route, we were focusing just on the ascent. But Basecamp is just as, if not more important because it's how many dollars leave Basecamp, how many dollars leave the business and become owner profit to then ascend up to the summit. That's really the question. So we want to look at the whole picture so that we can make sure as much revenue is leaving in terms of profit, given the constraints of how the business is built, and then how do we protect those on the ascent? So that's the next part here. Well, this is what I was saying earlier of size, tier, and type. These are all different factors on the guardrails for the Basecamp. So the ascent. This is our 4 steps of the ascent: survey, route, trek, compass checks, like I talked about before. So in the survey, what we're going to be doing is establishing the real Basecamp position before we prescribe ascent strategy. And then the route is, the path going from Basecamp to the summit. And the trek is doing that work, implementing all the plans. Compass checks is, anytime you're following a map, you got to make sure you're still on the path as you go. That's that feedback process. Because the only constant in life is change, so all projections and models are wrong, but some are useful. And so the compass check is always coming back later and making sure that we're on target. An example from a client this year was, very successful client. It's been in business a number of years. Business has been pretty steady over a number of years. And this year, he had thought that the AI-driven development tools were going to give him extra time. And like every business owner, what did he do with that extra time? It's like, well, he created more revenue. So now, we're halfway through the year, and he was sending some updates that I was modeling out. And, it looks like his after-tax his pre-tax income is going up by 13%, which for him is a significant number and is going to affect the decisions to make inside the strategies that are available to him. So that's that compass check process of doing feedback, figuring out, okay, have things moved? Do we have to adjust our plan? All those kinds of things. And then, within the route or within the ascent, we have a 4-step process, which is entity optimization, deductions and credits, income optimization, what remains, and then the exotics, if you have sufficient income after all that is done, which is a bit more advanced for higher income, where you can buy deductions, you can buy credits, and you can do these in tax advantaged ways. So then the trek is, like I said, actually doing all the work, and compass checks is, doing all those adjustments. So when it goes through that process, the summit is the lasting wealth. And fundamentally, money that reaches the summit, you have a couple options. So 1, you can spend it. That's the lifestyle. 2, you can invest in your family, and that's going to take the form of setting up kids or sometimes grandkids and allocating capital to their future. And the 3rd is retirement. And retirement doesn't need to be age 65 or 67, whatever. It just means providing that optionality on working. So even if you take all the savings that we generate by optimizing Basecamp and optimizing the ascent, and so more money is reaching the summit, if you don't have a plan, then most people end up blowing that money, which I still think is preferable to setting it to the government. But ideally, you would develop your asset base, develop your own wealth base to then provide additional income, which over time can then be spent on lifestyle or additional compounding. So, because fundamentally, those are the 2 choices. For any dollar that reaches the summit, do I invest, whether it be in my own asset base or my kids' asset base or my grandkids, whatever? That's option 1. Option 2 is I spend it on lifestyle. There is no 3rd option for money that hits the summit. And so, you make your own choices, obviously. I did a conference in Vegas, I guess it was last year or the year before, and I was telling them, it's like, I would prefer if you save $50,000 on your taxes, I would prefer, taking that $50,000 and put it all on black on roulette and lose and give the money to the casino than giving the money to the government. And that's part of my larger mission to defund the government. But but still, for your own benefit, the more optimal approach is to build that asset base so that it can throw off income, so that it provides that optionality in the future. So, how does this fail? What are the failure modes? Skipping Basecamp. That's the most common failure mode, actually. So, if your business is broken and doesn't throw off enough owner profit, then you're stuck, right? You can't get out of Basecamp. All your dollars are running around Basecamp, getting ready, but they're not acclimating. They're not, actually leaving Basecamp to go up the mountain. Some people try to skip the ascent. I was talking to a guy, a very wealthy guy, last week, and he was saying, yeah, he doesn't do any tax strategy because, for him, it's, he's just scared of the IRS, basically. And I was like, yeah, that's an option, but, you're just limiting your wealth building that much more, which I think is not a good decision, but everybody makes their own choices. And then if your dollars do get out of Basecamp and they do make the ascent, are they just losing all at the end by blowing it all on lifestyle cost? Those are the three basic failure modes. So the climb only works when all three layers stay connected and you're operating this holistically. So revenue turns into profit, which turns into usable money, which turns into assets, which turns into optionality. That's the full path. And those assets creating the optionality, you can use that to reinvest either in your own business, into another business, into additional investments, all kinds of things. So yeah, when it comes to Tax Sherpa specifically, obviously we are highly involved on the tax side of things. We do tax strategy and tax prep, but then we have expanded to bookkeeping and CFO services and all the things in Basecamp to help people understand what's going on in their business more. And so that is the realization that I had over this past week, and how we are changing the route to include these other elements. So I hope that makes sense to people. The way I imagine, the journey of these dollars going up the mountain is, so they enter Basecamp in revenue, then they leave in various ways. There's fulfillment cost, there's customer acquisition cost, there's OpEx systems cost, there's OpEx people cost. So question number one becomes how many dollars are leaving Basecamp and going back down the mountain with those things? Is it too much? Is it too little? Is it just right? And the goal of that is to maximize the owner profit exiting Basecamp and going up the mountain. And I imagine all the obstacles as boulders rolling down the mountain and just knocking out, your dollars trying to make that ascent. And the boulders are different things. There's those different spending categories. There's inflation. There's pricing. There's vendor relations. There's financing. Those are all Basecamp boulders. And then as the dollars that survive and go up the mountain, now the boulders are changing into inflation and taxes. Taxes being the largest boulder. And so imagine they're climbing up the mountain. There are some paths that are tunnels in the mountain, so you can actually bypass the boulders coming down entirely. Others are, safer paths, more risky paths, and you have because taxes are fairly deterministic, we have the advantage of knowing where those boulders are going to fall based on the number of dollars leaving Basecamp and going up the mountain into the ascent. And then we want to maximize the number reaching the summit, and then there we have choices, lifestyle, investment of various kinds. And I'm not a investment snob, I guess, or a chauvinist, or what have you. I'm, once upon a time I took the Series 65 test and passed it because my idea was to help people with their investments, because I had been at that point investing on my own for, I don't know, 12 or 15 years, something like that. I was really disillusioned by that whole process, actually, because the Series 65, which is for investment advisor licensing, very, very little of it is like, do you know how to invest? Most of it is, do you understand the Securities Act of 1933 and what you can tell an insurance company and what you can tell this person and that kind of stuff. Which, is maybe I was naive going into it, but I was I was pretty disheartened about that whole thing. So so the point is that for me, whether you want to invest in index funds or you're a stock picker or you love bonds or you're a Forex person or you're real estate or you trade options or you like to buy businesses, it all functions the same way to me. And, different assets types have different tax considerations later on, but, the goal is the same: building up wealth in order to generate usable, durable cash flow to fund your lifestyle as the end goal. Because otherwise, you're going to be relying on Social Security. And I don't know if you've seen the reports from the trustees over the recent years, but basically, we are in 2026. The trustees are saying the assets of the Social Security Trust Fund are going to, be eroded entirely by 2032. So that's 6 years. And at that point, basically, there will only be enough inflows from payroll taxes to pay for about 75% of current benefits. So, what that means is either they're going to make up the shortfall with inflation, or they're going to raise taxes, or some combination. And I think some combination is the real answer. I've done the math on right now. There's a cap on how much of your wages get taxed for Social Security, and it changes every year. It's been, jumping by about $20,000 a year for the past couple of years, and I think they're going to remove that cap, and that'll get another year or year and a half out of the system before it runs out of assets. But after that, what's going to happen? And I think the answer is taxes and inflation, fundamentally. And they don't call it inflation; they call it borrowing, and then the Fed monetizes the debt, and then that turns into base money, which then gets lent into the system through the fractional reserve banks, and that's what creates inflation. So it's not a direct one-to-one path, but that's the mechanism which starts the inflationary pressure. But if you want to read about that, you can look into a lot of modern Austrian economics writers talking about that. But that's the alternative. And so personally, I think Social Security will continue to exist. I think it'll continue for a long time. I just think in real purchasing terms, it's going to buy less and less. It already doesn't buy much. Social Security is not an investment, but if you looked at the cash flows of working over your lifetime, contributing dollars in payroll taxes to the Social Security program, and then what you get back out, the internal rate of return on that cash flow series is usually less than 1%. And the more you make, the lower that return is. So you are better off doing almost anything, as long as you are actually investing it. Now, if you're just blowing all the money, then maybe Social Security is a better alternative. But for everybody who is actually trying to save and invest for their future or their kids' future, then just about anything is better than Social Security because of that internal rate of return. So that is what's going on in the Tax Sherpa world that I wanted to talk to you guys about. And for those of you who are in the school group, I'm going to be updating some of the modules there about where this fits into the wealth climb. And let's see. Do I have the chart up? Let's see. I did create a Lucid chart. I'm a fan of Lucid chart, so let's share this tab instead. So this is a little bit more detail on the wealth climb with the 3 elements. There's Basecamp, Ascent, and Summit. So Basecamp is these functions. Revenue comes in. And, every business has 4 basic functions. There's marketing, sales, fulfillment, and support. Doesn't matter what you do, you have those 4 functions in your business. The way you implement those functions, sky's the limit as far as variety of ways of doing those things. But within there, we have these different cash flows. So there's revenue. Revenue gets paid out to COGS or variable expenses. This is your fulfillment expense. And then revenue after COGS is gross profit. So this minus that is gross profit. After you have gross profit, the question becomes, what do you do with it? And you spend it in 3 different ways. You spend it on acquiring more customers. So that's going back to the head of the funnel and spending on marketing, which leads to more revenue, hopefully. Or you spend it on operating expenses, people and systems. And this is simplified, so any purists out there say, "What about capex?" It's like, okay, fine. But this is a simplified diagram, obviously. So this is the ClearPath framework right here, and it's the ClearPath Insight framework. What it does is it looks at your revenue, it looks at your fulfillment costs, it looks at your gross profit, and then it compares all those things to one another. And like, given your gross profit, how much money should you be spending on customer acquisition cost? With the given customer acquisition cost, there's front end revenue and then there's lifetime value. And so the ideal situation is you acquire a customer at break even or better, and the lifetime value of that customer is 6 times the acquisition cost. Why 6? Because that's the number that works. So the numbers that are the ratios that I've developed for the ClearPath started off as profit first. So I'm a profit first professional, and Mike Michalowicz created this system with his own experience on small business, and I, generally agree with him. My point of disagreement with him is 2 things. So one is he doesn't split up his operating expenses the way I do, and they focus primarily on owner profit percentage, and that's all well and good. But what I have seen with customers and clients and people I've talked to over the years, looking at thousands of business financials, is that if your lifetime value to customer acquisition cost is above 6, if it's 7 or 10 or 12, what that means is you're not spending enough on marketing. Because yes, that does decrease your owner profit percentage. True. However, it limits your aggregate owner profit dollars. And you can't live on percentages. What we live on is dollars. And so if your lifetime value to CAC is too high, that means you are giving up additional revenue that could be making its way through your system and lowering your overall owner profit. So fundamentally, these are the money flows inside of a small business. And the money leaving comes up here to owner profit. We want to make that number as big as possible given the structure of the Basecamp business. And then these dollars begin the Ascent. And the operating question for the Ascent is, how do we get as much owner profit to the summit? And, we have our 4 steps here. We have entity structuring, deductions and credits, we have income optimization, and we have the exotics. And then the boulders coming down here are income taxes and payroll taxes, fundamentally. So these money flows are coming in, and they are going up to the summit. And we want these wealth allocation flows to be as large as possible. And depending on if you have kids or not, and whether they fit into the strategy, you might be building value in kids' wealth and changing your spending patterns so that kid luxuries are bought by the kid bank accounts, which overall is going to maximize the dollars hitting the checking account, basically. And then the checking account, they can go into different places. They can go into investments, you can go into insurance, you can go into retirement plans. And these are obviously broad categories, like I was talking about earlier. But once money has entered the Owner Wealth Summit, what happens? Like I said, we've got 2 choices, lifestyle or compounding. Ideally, we want to keep lifestyle the same for what you've been doing for the last however many years, because obviously you've survived that, and compound the owner wealth as quickly as possible. Grow this rapidly so that then we can flip the switch and start taking lifestyle out of this. And at that point, Basecamp becomes optional. So you could continue to run it, sure, but it's optional because you don't need the money anymore. And whatever money does come out, we still want to keep protecting, but optionality is nice. And then you can grow the summit that much more, or you can start living high on the hog. Up to you. So that's the overall 3 parts of the wealth climb of dollars starting at revenue and then going through Basecamp, up through the Ascent, into the summit, reinvesting, and then coming out as a real nice lifestyle on the back end of it. That's the whole purpose. And the new routes are going to encompass all of this. So that's the big change. And I hope that makes sense. What I do like about this framework is that I think, and the people I've shared it with directly, I have I asked them, like, does this make sense? Does the story, is it understandable? And people have said yes, that they can get a handle on the metaphor that we are working with here. Because you can imagine in your mind, there's Basecamp down at the base of the mountain, dollars running around, getting ready. Some are leaving, going off in the spending and various things, and then they start trudging up the ascent of the mountain. And some of them get wiped out in taxes. Some of them get wiped out in inflation. We protect as many as possible, and the survivors make it to the summit, and then they have their castle or whatever that they're building at the top, however you want to envision that. And the larger that structure gets, the more resilient it is to economic downturns, to COVID shutdowns, to whatever. Because, like I said, the only constant is change. So that's the job, right? And I asked at the beginning of this coffee break, which I always have my coffee or my tea actually sitting here, and it's starting to get cold. But I asked at the beginning, it's like, what is a dollar's purpose when it comes in as revenue? So the purpose is reaching the summit, developing your own wealth to support you and your family. And if you want to support charitable organizations or a community or whatever, that's great. Do all that, but that comes from your own owner wealth summit. That's different than your purpose. It's different than the business's purpose. So the business's purpose, so like the larger business purpose of Tax Sherpa is to defund the government. I think that is a moral imperative for me, and that's what gets me, out of bed every day. In fact, do I have my cards over here? People don't believe me about how serious I am about this, but these are my business cards. Defund the government. It looks backwards, but defund the government legally. That's the actual purpose of Tax Sherpa. That's not the purpose of a dollar of revenue, though. So the dollar of revenue, its purpose, its job, is to reach the summit and build my owner wealth. The purpose of your dollars of revenue is to reach the summit and build your owner wealth, so that you can build that freedom, build that optionality. And we're going to be doing a lot more direct support for people. So, I know we're over time already, but the tooling that I've been building for the last 6 months has been really helpful in that now we have the resources to point people to. So, like, if somebody wants to implement the ClearPath framework, it's like, yeah, that's great. If you're under 250K in revenue, it doesn't make sense to hire bookkeeping. Instead, what you should do is you should go to Bookkeeping Buddy, use bookkeepingbuddy.com. Use that system. You just drag and drop your bank statements and your credit card statements, and it automatically creates a profit and loss statement, which is great. But then the question becomes, okay, so what? What do I do with this? Well, what you do with it is you apply the ClearPath framework, which I've developed tooling for. I need to improve that a bit. And it'll help you understand the story that those numbers are telling you. And then you can start to make changes and improve your business and increase the amount of owner profit. If you're over 250, then yeah, you do need professional bookkeeping. And there's logistical reasons why that break is at 250 in terms of how the tax returns are actually filed. And if you're over $1 million, then you probably need actual fractional CFO help, and we help with that as well. And so all of that leads to dollars beginning the Ascent, and then that's where the tax strategy comes in, and we help you map that out, and then that leads you to the summit. And at that point, we can start to make projections. We don't sell any investments or anything like that, but a lot of times part of our routes is you need to set yourself up a 401k plan, or you should invest in something. And we obviously customize everything to our clients' interests and desires. Some people like real estate, some people don't. Some people want to build a huge stock portfolio. Other people don't care about stocks at all. Some people are convinced that the paper markets are going to crash, and so they only want gold and Bitcoin. And so whatever that thing is that you are interested in doing, we'll help you map out the plan for that and how that works over time, and how that builds the wealth over time. And so my ideal recommendation: we optimize the financial insides of the Basecamp business, get as much owner profit coming out, keep as much of it into the summit, and then build that summit asset as quickly as possible in order to get to that financial freedom optionality point as quickly as possible. So that's the plan. And ideally, everybody will start to implement in this kind of way. So if you need help with that, definitely reach out at taxsherpa.com. We can start to have those conversations. But fundamentally, if you just do nothing but take the free resources that I put on the school group and put out in tools, take all those and then apply those to your own life so that you are maximizing your own financial wealth and reducing your dependence on the government or the dollar or Social Security or whatever, so that you have maximum freedom and maximum optionality. All right, so that's it for this week for the coffee break. Next week, I'll be at the beach actually next week, but I will see if the internet setup will support doing a stream. But assuming that it does, I will see you guys next Friday.